We also have Mr. Surana joining us now from HPCL on their quarterly numbers. So let me welcome him in. Mr. Surana, good morning. To begin with, record performance this quarter despite challenging times. Is this a trend that you see continuing?
Yes, this was a difficult time, as all of you know, because of Corona pandemic. And in this time, I think the company has produced reasonable results. Now, as far as this quarter is concerned, one differentiator which we have is that we ran our refineries to almost 100% of the capacities. In spite of demand contractions, more so in April, but subsequently picked up in May and June. Because our marketing capacities are higher than refining capacity, to that extent it helped us to run our refineries to full capacity. Marketing infrastructure also helped us to take the product and store it at various locations, cross-country pipeline network. So the profit was 2,800 crore, which was backed by the almost 100% capacity utilization and almost 91% of the market sales coming up as far as the June month is concerned. Or on an average through the quarter, if we see that the demand contraction was there in the industry to the extent of around 29.2%, but for HPCL it was 25.8%. LPG demand was higher, and for the domestic LPG almost it was up around 24% compared to even last year. On specialty products, we did well because we could place the products in time when the demand was picking up. Added to that, as compared to the previous quarters where there were substantial inventory losses, this quarter actually we did not suffer the inventory losses. To that extent, it helped us to post a reasonable profit compared to the last sequential quarter, which was marred by substantial inventory losses.
Okay, how are demand trends panning out versus last month? What kind of capacity utilization are you operating on? So,
if you see the demand side, in April, the demand of the total products almost came down by almost 48.5% down. So it was only around 50% of what we normally have for the same period previous year. Then in May and June, after 20th April, there were some relaxation were announced by central government and some of the state governments, and there was gradual relaxation. So to that extent, the demand in May picked up around 77%, and in June it came almost to 91%. Overall, all the products put together. If we talk about petrol and diesel, the demand of petrol in April, it came down to around 37%. Diesel came down to 44%. It picked up to around 85% in June. Now, as far as July is concerned, in July for petrol demand is almost 89% of what we saw in July 2019. And diesel is around 83% of what was there in July 2019. And this trend you will observe almost year on year, that in the second quarter, once the monsoon sets in, the demand of diesel comes down. Also because the agricultural consumption of diesel comes down. And even the transportation activities also reduces to some extent. Now this year it is also added by some local lockdowns in some of the cities of 1 week lockdowns, etc. And there is also flood in Bihar, which is also a consuming area. But overall, structurally, if we see, the demand pickup was quite sharp to come back from 50% to almost 85%. And I don't see any structural issue to that effect. The seasonal impact is there, which should again pick up in Q3 as the monsoon recedes and the festive season takes place. And from 90% beyond, I think it will take time once the industrial activities picks up fully and the construction activities start fully. There still, it will take some time. Also because the aviation sector has not yet picked up. The aviation demand is still almost 30-35% of what was there in July last year. And added to aviation, though the ATF demand gets impacted, also the people who are traveling to the airport, coming back from the airport, to that extent, it also have got some impact in the transportation fuels. So I think considering the complete lockdown and the gradual relaxation, still some of the restrictions still on, I think it is quite a reasonable pickup in the demand. And we are seeing it not only in the transportation fuels, but also in other products like lubricants, bitumen, naphtha, fuel oil.
Sure. Mr. Surana, if you could also highlight your GRMs and what kind of trends do you see developing there?
If you would have observed, the gross refining margin had been subdued over few quarters, primarily because of the product cracks. The petrol cracks in the current quarter average around $0.5. The highest it has gone up to $4.99. The lowest it gone even up to minus some $5 someday. If we see the same thing last quarter, last year same quarter, it was around $5.75. HSD this year this quarter average around $3.18. Last year the same quarter it was around $10.95. So there had been stress on the cracks, product cracks, primarily because of surplus inventories available, which are still overhanging. So till a substantial part of the inventory gets absorbed, the cracks will remain under pressure. The diesel cracks have started picking up a little bit after the European countries, the demand pickup was there. Gasoline pickup is there, but not substantial, though there is a demand pickup in US. But the second wave of Corona, which has been hard, that has again put some dampeners to that effect. I think that the Singapore benchmark GRMs were average around $0.93 minus in this quarter. So compared to that $0.04 which we have posted is a reasonable one. Of course, Singapore GRM has same day crude and same day products, while in our case it will be the actual day crude and actual day product. So the inventory gain loss impact, if you account, ours will be somewhere around minus 0.85, and it is same in line with the Singapore GRM, slightly better than Singapore GRM. Going forward, once the inventories of petrol and diesel get absorbed to some extent and the demand pickup happens, I think Q3 onwards it should start showing a better trend. As far as crude prices are concerned, it has hovered somewhere in 40 to 45 range for some time. Just last 2 days, it has gone over 44. And that was primarily because the tightness in the supply side and the demand pickup, there was a mismatch. So demand picked up quicker than the people had anticipated. Now in August month, there will be some relaxation in the supply side, almost 2 million barrels per day. And to that effect, I think that the crude price should remain in this range.
Sure. What about your non-refining margins, given that amongst all PSUs, you are the largest exporter for lubricants?
So as you know that we have got the biggest lube refinery in the country, and we are also the largest marketer of lube in the country. Then we had been concentrating on the value-added lubes. In fact, we do supply base oils to our competitors also in the country. And so we started expanding our horizon to foreign countries. And as of today, we export lube to around 11 countries. And we had almost exported 3,000 plus ton of lube in the quarter, which was one of the largest export of the lubes in the country from OMCs at least. So lube had been our bright spot in whether it is production, whether it is marketing. And if really to tell you, between April to July, total sales of lube has crossed the total sales of lube in the same period last year already, in spite of the lockdown. One of the reason was that we had the products in place. We had kept our contact during the lockdown period, had engaged with them to ensure that when they are starting, when they are not starting, when the demand centers are coming up, And so we were able to position the non-fuel products also properly. In fact, we have exported even RPO, MTO, some of the specialty products also during this quarter. So we did reasonably well on the non-fuel products as well, and that has reflected in the profitability as well. One thing I'd like to tell is the last quarter we shifted to the lower tax regime. So in the PAT, you will see that positive impact.
Mr. Surana, how are your marketing margins shaping up and what is the outlook here?
So the marketing margin are in the range of what we normally have. Of course, this quarter has seen up and down because of the quite some volatility in the product prices and the crude prices. And there was an abnormal quarter, but on an average, we see the trend to be in the range which we normally have. And as you know, the marketing margins get calculated based on certain formulation based on the international product prices. And I think we should be able to manage to have the normal average margins which we have generally.
We'll let you go on that note, Mr. Surana. Appreciate you taking the time out and joining in with that perspective on the company. Just want to take a moment as well to mark the Mindspace REIT as well, which is due for its listing today. Remember, the issue price was set at 275 rupees per share. And a lot of investors as well as funds were recommending that it can accrue a substantial return from the rental yield. And that's just a quick look at what's happening with the Mindspace REIT. Quick break right here on the show. Stay with us for lots more.